Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
$239.27. That is the number on the screen right now, Friday, January 30, 2026. If you've been watching the tape today, you're looking at a crime scene. Take-Two Interactive has just endured a liquidation event, wiping out months of gains in a single afternoon. We're down nearly 18% intraday. We have smashed through the 200-day simple moving average at $243. That's the long-term trend line that tells the algorithms whether to buy or sell, and it didn't just break, it evaporated.
It evaporated because the market finally realized that the floor was made of rotten wood. You can't call this a technical breakdown or some kind of glitch. This is a fundamental repricing of how video games are made. It's the Google announcement. Project Genie went live this morning. We saw real-time 3D generative AI creating playable environments from, just text prompts. And suddenly Wall Street looked at Unity down 25%, Roblox down 14%, and Take-Two, and realized that spending 5 years and $1 billion to handcraft a virtual city might be an obsolete business model.
And that reaction is exactly why I'm taking the other side of this trade. It is the definition of panic. I mean, we are seeing a massive discount on the GTA 6 Premium because of a tech demo from Google that has zero impact on what Rockstar Games is shipping in November. So the central question we have to answer today isn't really about AI rendering. It is this: is today's crash a gift? Is this a liquidity floor opportunity for the last true giant in the gaming industry? Or are you right? Is the AAA blockbuster model actually dead?
Dead? Maybe not, but uninvestable at these multiples? Absolutely. You're trying to catch a falling knife. I'm looking at a stock that is effectively a call option, a bet on a single future event for fiscal year 2027. We are paying a massive premium for Grand Theft Auto 6, a product that has already drifted on the calendar once. The market is waking up to the fact that Rockstar's bespoke method, where, thousands of humans detail every single sidewalk crack, is a financial liability in a world where AI just promised to do it for pennies.
A liability. It's the moat. But look, before we even get to the AI, we have to look at the scarcity here. You have to understand what Take-Two is right now. It is the only viable vehicle left for large-cap gaming exposure. Electronic Arts is practically private with the Saudi PIF deal closing. Ubisoft is a penny stock now. If you want to invest in gaming, you have to own Take-Two. And purely on the numbers, the market is just wrong. Fiscal Q2 net bookings hit $1.96 billion. They beat the high end of guidance.
You're looking in the rearview mirror.
I'm looking at execution. NBA 2K26 launched in September and moved 5 million units, just like that. Recurrent consumer spending, that's the microtransactions, the actual high-margin cash flow, is up 20%. They raised full-year guidance to $6.5 billion. When a company tells you, we are going to make more money than we thought, and the stock drops 18% because Google issued a press release, that is a dislocation. That is a buying opportunity at 233.
A guidance raise means nothing if the valuation is detached from reality. Let's actually look at the math, because I think you're ignoring the price tag here. Take-Two has negative trailing earnings. We can't even value them on what they've done in the past year. So we have to look at the forward PE, the price-to-earnings ratio, based on what we hope they earn in 2027. That number is sitting at, 43.5x. The industry average is 17x.
Because you're paying for quality.
You are paying double the industry average for earnings that don't even exist yet. You are paying for a supercycle that is now delayed until November 19th, 2026. That delay pushes the cash flow deeper into the future, and, money has a cost. But the bigger issue is the Google threat. Project Genie claims they can automate 60% of environment creation at 10% of the cost. If that is even remotely true, then Rockstar spending $2 billion on human labor to build Vice City isn't quality, it's financial malpractice.
That is the most common misconception in tech right now, this idea that efficiency equals value in entertainment. Let's talk about Project Genie. Yes, Google showed a demo where you type Cyberpunk City and it generates a 3D street. It's impressive. But do you know what it lacked? Soul, satire, cultural specificity. The value of a Rockstar game isn't just that the map is big, it's the human capital nuance. It's the writing, the acting, the specific placement of a billboard just to make a joke about American consumerism. AI cannot replicate that.
It doesn't have to replicate the satire to destroy the margins, though. That's the entire point. If a competitor, say a startup using Project Genie, can build the canvas of the city for $500 instead of $50 million, they can iterate faster. They can flood the market with content. It commoditizes the open world, and Take-Two knows this. Their relationship with Google is already strained. This announcement was a direct shot across the bow of what we call the prestige pipeline, the idea that games take 7 years to make because they have to.
But Take-Two isn't just watching this happen. They aren't Luddites. Look at the infrastructure. You're ignoring the Microsoft alliance. They're utilizing Azure, Microsoft's cloud, for their massive live services backbone. Azure usage is up 39%, and Take-Two is riding that for service stability. But more importantly, Agent 365.
Which is back-end IT support. I mean, it's boring.
It is critical. Agent 365 is Microsoft's governance layer for AI agents. Take-Two is likely integrating this into customer support and server management for what will become GTA Online 2. They are using AI to slash the boring costs, the server maintenance, the bug squashing, so they can afford to keep the expensive humans on the creative side. They're optimizing with AI, not being replaced by it.
Optimizing is a nice buzzword, but it doesn't solve the sentiment crash we saw today. Investors look at AAA gaming and see Blockbuster Video in 2005. Expensive, slow, and about to be eaten by something cheap and fast. And since we're talking about partners, we need to talk about the hardware. You're banking on this massive launch in November 2026, but the ecosystem is cracking.
If you're talking about Nintendo, that's a sideshow. The partner that matters for GTA 6 is Sony. The relationship with Sony Interactive Entertainment is the fortress here. Industry insiders have effectively confirmed an exclusive marketing deal. We are talking about PlayStation 5 Pro co-development.
Okay. Explain that. Because to me, co-development sounds a lot like the game doesn't run well.
Not at all. It means Sony engineers are working directly with Rockstar to optimize for PSSR2. That's PlayStation's Spectral Super Resolution. It's their AI upscaling tech. It allows the console to output 4K resolution without, melting the graphics card. This implies that GTA 6 is going to be the technical showcase for the PS5 Pro. Sony is going to put their entire marketing weight behind this. When you have Sony treating your product as the reason to buy their console, you have a distribution safety net that Unity or Roblox simply do not have.
That is a compelling argument for Sony, sure, but Take-Two claims to be a diversified publisher. If GTA is the only thing that matters, then, spin off 2K and let's call it a day. But they haven't. And looking at Nintendo, the indefinite delay of Borderlands 4 on the Switch 2 is a massive red flag. They cited technical debt and performance bottlenecks.
That's quality control. They aren't going to release a broken game.
They are missing the launch window. September 23, 2025. That was the target. Now it's indefinite. That is revenue, hundreds of millions of dollars, that was modeled for fiscal 26. That is now just gone. It contributes to the pipeline drift. You have engineering teams hitting walls on new hardware. If they can't get Borderlands, which is a stylized, less photorealistic game, running on the Switch 2, why should we trust the timelines for anything else?
Because they are allocating resources where the money is. They're still confirming NBA 2K26 and WWE for the Switch 2, because those are annual cash cows. And if we want to talk about smart pivots, look at the Netflix partnership. WWE 2K Mobile launching in fall 2025 on Netflix games. That is a brilliant strategy.
Is it, or is it a desperate search for users?
It's margin protection. By launching on Netflix, they bypass the 30% Apple tax on the App Store, and they get instant access to 200 million subscribers who don't have to pay extra to try the game. It lowers the barrier to entry to zero. That is how you grow the funnel.
It's a nice hedge, I'll grant you, but mobile ports on Netflix don't move a $45 billion market cap. What moves the cap is the perception of being the pure play leader.
And I want to go back to that pure play argument you made. You said investors have to own Take-Two because there's nowhere else to go.
Correct. Institutional mandates. If you are Vanguard or BlackRock and you have a technology and gaming fund, you have billions that must be deployed in the sector. You can't put it in EA anymore, it's going private. You certainly aren't putting it in Ubisoft. Take-Two is the only liquidity bucket large enough to hold that capital.
So your investment thesis is institutional inertia? The stock price is held up simple because the big funds are trapped? That is a terrifying thesis for a retail investor. It means the price isn't based on value, it's based on a lack of alternatives.
It's a reality of market structure. Scarcity creates a premium.
But the smart money is starting to reject that premium. You mentioned BlackRock, and yes, they added shares, but that's likely just index matching. But look at the active managers, Capital International Investors. In their most recent 13F filing, they dumped 2.65 million shares. That is a 63% reduction in their position. They didn't just trim, they ran for the exits. That tells me the consensus is fracturing. One side plays the liquidity game, the other looks at that 43x PE ratio and says, I'm out.
Institutions rotate, it happens. But let's look at the mechanics of the trade right now because there is an explosive setup here for the bulls. The short interest is sitting at 8.3 million shares.
Which is high.
It's fuel. The days to cover ratio is over 7. For our listeners, that means based on average daily trading volume, it would take short sellers 7 full days of just buying to close out their positions. If we get a single positive catalyst, a new trailer, a tweet from Rockstar, those shorts get squeezed. They have to buy at any price. That is a powder keg.
Or it's a sign that the smart desks are betting against the timeline. I track the plumbing of the market, the dark pools. These are private exchanges where institutions trade to avoid moving the public price. On January 6, the off-exchange short volume ratio was 58%. More than half of the shorting is happening in the dark. That isn't a squeeze setup. That is a coordinated bearish bet by people who likely have better information than we do.
You can interpret dark pool data a dozen ways. High volume often just means market making.
Then interpret the insider activity. Director Ellen F. Siminoff sold shares on January 15th. She sold in December too, 2 sales in 60 days. In fact, there have been 0 open market buys from insiders in the last year. If the stock is such a technical exhaustion buy at 233, why aren't the people running the company buying it?
Well, those are Rule 10b5-1 trading plans. They are automated sales set up months in advance to avoid insider trading accusations. You know that. It doesn't reflect current sentiment.
It reflects a lack of desire to stop the autopilot. If they thought the stock was going to double in 2027, they would cancel the sales. But let's move to something that is reflecting sentiment in real time, Polymarket. We talk about the stock tape, but the prediction markets are often sharper.
I track it too, and I see a market that is thin and frankly prone to manipulation.
It's money on the line. As the stock dropped today, the no contract for the GTA 6 released in 2026 market surged. The crowd wisdom is pricing in only a 41% chance that the game actually hits that November 19 date. The crowd is screaming, delay.
The crowd on Polymarket is also dealing with the liquidity trap, the 50-50 scam.
Explain that, because it's actually a fascinating distortion.
It's a flaw in how the contracts are written. For markets like will X happen before GTA V, if neither event happens by July 2026, the contract resolves 50-50. Since the game is now officially delayed to November, those markets are dead money. Your capital gets locked up for months just to get half of it back. It has killed the volume. So you aren't seeing wisdom of the crowd, you're seeing a ghost town. The hype money has left the prediction markets.
Which supports my point. The speculative fervor has cooled. The hype is gone. That leaves us with the bare fundamentals, which, as I've noted, are currently negative.
I'm not convinced by the Polymarket signal. But let's step back to the fundamentals. You say they're negative, I say they are dormant. The record-level net bookings for fiscal 2027 aren't a fantasy. They are mathematically locked in by the installed base of consoles and the demand for the IP. Even if AI changes the cost structure of future games, it doesn't change the demand for this game. The drop to $239 is a gift. We have earnings coming up on February 3rd.
And that earnings report is exactly why I'm terrified. Take-Two is a temporarily misplaced company. They are living in the future, talking about 2027 profits, but trading in the present. The risk of another delay combined with this earnings bridge gap, where they aren't making money now, makes it too risky. If they guide down next Tuesday, or if they admit that the Switch 2 issues are deeper than they're letting on, that 233 floor isn't going to hold. We could see 200.
I respectfully disagree. The 200-day breach today flushes out the weak hands. The smart money that is selling is just locking in gains. The patient capital, the folks looking at the 2027 windfall, they're stepping in right here. This is the last pure play. You can't buy the sector without buying Take-Two.
Well, we agree on one thing. The stock is effectively a proxy for the date November 19, 2026. Everything else, the Netflix deals, the AI agents, it's all just noise. Next week's earnings will determine if the live services growth is enough to keep the lights on while we wait.
Exactly. It's a complex trade, but the potential upside is historic.
Or the disappointment is.
We'll see what the numbers say on Tuesday.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.